Nigerian forex users are currently trying to wrap their heads around the many circulars being issued by the Central Bank of Nigeria, with the introduction by the Apex Bank of the new policy on monetary remittances from the diaspora. Joining the program now to take us through this new policy and its likely impact on the management of the forex regime is Bismarck Rewane, Managing Director and Member, Presidential Economic Advisory Council. Mr. Rewane, good morning, and thank you for joining us.
Good morning, Ruben, for having me.
Good to have you. Well, very quickly, I mean, the Diaspora Remittances policy recently announced by the CBN has been described by some people as a game changer. How much of a game changer is it with regard to the linkage between migration and remittances and development, considering the fact that what we're talking about here is really personal money from a Nigerian diaspora, maybe to a family member? How much of a game changer is it?
Well, it is a game changer to the extent that there is a shortage of foreign exchange in Nigeria. We know that already. Secondly, the inflows into the system is what you use to make up for the balance of trade deficit which we are facing. We've had a balance of trade deficit of about $12 billion in the last 1 year. But prior to that, we've had balance of trade surpluses. But you make up for the shortfall on the balance of trade with this investment flows. Nigeria's control of investment flows, global investment flows, 0.35 of global investment flows. What this shows you and what this points to is the fact that the Central Bank of Nigeria wants to encourage Nigerian diaspora to bring their money in. For a point of reference, Nigeria is the 5th largest source of diaspora remittances in the world. I think number 1 is Philippines, India, and so on. Now, what does this mean? It means that you can bring your money in, 1. 2, you can get it in the currency in which you remitted it. And 3, you can sell it in the market. When I say the market, in the effective market, at a price at which is not controlled. Prior to this, if you brought the money in, it would be converted for you at a nominal price of what is obtainable on the I&E window. But the reality is that the effective price is different from the nominal price. And the exchange rate of a currency is the price of one currency in terms of another. So, every market has what you call an equilibrium price, where the demand and supply are equilibrated. And that particular price at which our currency clears is what you call the effective price of the currency.
Is the Nigeria special bill also a game changer?
I didn't hear that.
The Nigeria special bill, another CBN.
Oh yes, Nigeria special bill.
Yes, is that also a game changer?
Well, it is a movement in the right direction in the sense that October 23rd last year, the central bank actually prohibited, more or less, private individuals and institutions from participating in the open market operations market. Now, open market operations are usually used to manage bank liquidity in the system. And because foreign portfolio investors had come in and pension funds had come in, we saw a situation where the rates actually moved quite high. And so the central bank, by proscribing people from doing that, what happened was that there was excess liquidity outside the banking system, more or less. And then it brought rates crashing from an average around 14% to about 1%. So the reality is that today you have treasury bill rates at less than 1%, and you have inflation rate at more than 14%. This is a recipe for disaster. And so I think the central bank, in recognition of this anomaly, is trying to work its way back so that you can have a single yield curve. It says that these instruments would have a maturity of not more than 90 days and it'll be a zero coupon, which means you get your interest at the end of the period. So basically, you're trying to bring some stability and to change the trajectory of interest rates to bring it in the same direction or closer to the rate of inflation. But it will take a long time for you to have that. And if you don't have that closure or convergence between the interest rates and the rate of inflation, your currency will continuously be under pressure. And you know that the currency is under pressure.
And that leads me to my next question about this equilibrium. How can we achieve this equilibrium between the effective rate and, the nominal rate, sort of the I&E window rate? Why I say this is because there still looks like there's still sort of like a disparity. So it's sort of like a Main Street, Wall Street kind of dichotomy now. Because the CBN governor came out the other day to say that, oh, this so-called what we think might be the effective rate, that is a speculated rate that has been speculators on steroids now, that are going to the 490 or the 500 at some point, it's just 5%. It's just 5%. So most of the rate is still for them, it's still nominal rate at which they get that money to do the business. So how can we bring about that equilibrium, which is a big challenge?
With all due respect to the central bank, the reality is that today there's rationing of foreign exchange. If you ask any manufacturer today, they will tell you they're not getting as much as they would require. Part of it speculative demand, part of it out of fear, part of it is the risk premium. But the reality is that in economics, we say that you produce where your marginal rate, your marginal revenue equals your marginal cost. It doesn't matter what your average is. It doesn't matter whether 90% of your inventory is at one rate. You sell on the last effective price. So the test of it is that you go out there into the market and find out what is the price. I said it the other day on national television that, you see, the effective price is a rational price. The control price is an emotional price. If you want to talk about emotions, then you can, Dr. Ruben Abati will tell you about, you go and read Romeo and Juliet. If you want to talk about rational price and economics, you talk about Samuelson. The price, we call it the real effective exchange rate path. And that is a path at which the currency is in equilibrium. Right now, if you ask me, if I go out onto the street to find out what the price is, the official price, I may not be able to get it at the official price. And if I have to get it, I'll have to wait. So that creates a gap. That gap is filled by speculators. That gap is filled by people who take advantage of the situation. At times they win, at times they lose. But the reality is that they do take advantage of this situation. And what you are looking for is stability, predictability, and ability to bring the money in. It is because of this that you are now asking diaspora remittances and people bringing money into the market to please bring their money in. It is safe, you get true value, and you get fair value. You are not going to get a special price. That is the reality.
Well, I mean, the CBN governor issued a statement talking about measures to make sure that we do not have sharp practices with this new diaspora remittances policy. But a lot of people are skeptical because the old regime, you know, if you're a beneficiary of diaspora remittance, the banks could just choose to pay you in Naira.
Yeah.
And then, you know, the remittances will find a way to the parallel market. And there are measures in place to make sure that, you know, this is not the case this time around. People indulging in arbitrage, you know, round tripping, and what you talk about, you know, what you said about the convergence rate. Are we really sure that that will happen? Is there any mechanism in place to
in all fairness, the central bank has moved from 306 to 320, more or less, and to 360 to 380. But what the market needs is not just a rate. The market needs a mechanism and a management system which will produce a rate based on certain parameters. I heard you talking about a minute ago about the pricing of petroleum, that take away the charter and demurrage, that what you have is the crude price, the correlation between the crude price of crude petroleum and the price of refined petroleum in Nigeria. And that price is determined by a template. If you have the same in terms of determining what the exchange rate is in Nigeria, you have a mechanism. You don't have to publish it. And it's the Central Bank of Nigeria that has all the resources to do that. And you look at the competitiveness of our currency relative to those of our trading partners, you'll find out that you'll come up with a sweet spot, a rate that is not so divergent from reality. And that stops the sharp practices, that stops the people from thinking about it, and that stops that arbitrage opportunity. Arbitrage itself is an act of trying to bridge information asymmetry, and making sure that the market clears. And so you don't call arbitrage sharp practice. You call arbitrage, because the arbitrageurs also lose money. People have lost fortunes. But it's a process by which the market, people hedge against volatility. People hedge in the petroleum market, people hedge in the jet fuel market, people hedge in commodities, in sugar, in cocoa, right? And that's what's happening. So if you understand and believe in the theory of markets, Adam Smith says the invisible hand is the most powerful hand in markets. And then what we call the hidden hand, which is where the regulators try to intervene in the market, that hidden hand produces an artificial price. And that artificial price is not sustainable. So in all fairness and in fullness of time, I think the central bank is moving in the right direction in terms of trying to allow for a free market price to determine what diaspora remittances you can get your true value rather than a command value. If you do that and you reduce the rationing of foreign exchange in the official market, you'll find that the currency will appreciate, and it will stay that way because as long as you continue to feed that market with supply and you continue to allow willing buyers and sellers to do what they have to do. I think that is the situation. It's very simple, and I think everybody knows it, including the policymakers.
What's your take on the federal government's decision to effectively end the deregulation of petrol by pricing it at 162 naira 44 kobo per litre? Is this not a reversal of the policy and reintroducing the subsidy bill?
This is breaking news, as you say, but the reality is that as long as you're tying the price of refined products to the price of crude, one. Two, as long as you can use the exchange rate, effective exchange rate to determine that price, then you come up with a formula and a price that will get there. I don't think the pricing of petroleum is a subject of negotiation or should be a subject of negotiation. It should be a subject of market forces. And then the real question is that because the subsidy has been reduced or eliminated, the revenue of government is much more robust and much stronger. The question you and I should be asking is, what is the government doing with the revenue, the new and increased revenue? Is it being used to improve the quality of life of people? Is it having an impact on poverty? Is it having an impact on investment? Are investors coming to this sector? And if investors come into the sector and create jobs, then it's a win-win. But as long as all you are doing is improving government revenue and leaving the people to languish, then you will continue to have all sorts of resentment and protests. So I think it's a two-way thing. One, improve the revenue. Two, simultaneously increase the level of expenditure on healthcare, on education, on roads and infrastructure, so that the people can have a better and a much more sustainable quality of life.
All right. Obviously, this will have with this now, this will have an impact on governmental revenue. I mean, I'd like to know your take on that. And also, I want to talk a little bit about the balance of trade results that came out this morning. We've got a deficit on that. And I looked at a key sector, agriculture, because there was a lot of spending towards the agricultural sector by the CBN. We had schemes like Anchor Borrower Scheme and the like, for rice farmers. But when you see what we're churning out in terms of agriculture, putting out to other economies, it didn't move the needle. Sesame seed, for instance, 0.52% in the total trade. I didn't even see rice on the list, and I thought at some point there was a talk about being rice sufficient. We could even ship rice to other parts of Africa and other parts of the world. So what do we need to do as regards this? One, to be able to give us a balance of trade surplus, and secondly, to be able to effectively diversify this very, very mono economy.
See, the reality is that this evidence-based analysis will tell you that the government multiplier, if you put money through a government program into a project, you'll get some lift, but it won't be impactful. This economy is a 160 trillion naira economy, give or take 150 to 160 trillion naira economy. When you put 100 billion, or you put half a trillion, 500 billion into an economy, it's not going to move the needle. It has no catalytic effect whatsoever. So all you are going to have, you're going to be having photo ops and a lot of talk shops, sound bites, but it will get you nowhere. The reality is that if you have an exchange rate that is effective, if the borders are opened, right, you can then begin to deal with the issues of growth. Because at the end of the day, if the economy is not growing, you are going nowhere, right? So I tell you what will happen. Inflation is at 14.3. Food inflation is at 17.25. If the borders are open tomorrow, if the central bank releases money to all the manufacturers, output will increase almost simultaneously, almost within 90 days to 180 days. And you'll see with output increasing and money supply staying stagnant, interest rates increasing somewhat, you will bring inflation under control, growth will take off, and things will be much better. I mean, it's not a silver bullet, but it's something that will help to get things done. But every day we go and talk about these programs. The programs are well-meaning. They are there, but they will not achieve the desired objective. I don't think so at this point in time. If you look at the default rate amongst agricultural borrowers, if you look at that, it's even more frightening. So, but what's the alternative? I think what's happening here is that the central bank would try its best, the Ministry of Agriculture would try its best, but you need to complement this with private sector investment. Without investment, you are not going to achieve accelerated and sustainable growth. It is important. It's not even open to doubts. It is there. I mean, it's an open secret that in economics, the investment multiplier, private sector investment multiplier, is always infinitely higher than the government multiplier.
I saw someone sending me a WhatsApp message saying that he would like you to comment on the continued closure of our land borders, considering the fact that there have been discordant tunes from government officials. The Minister of Agriculture says government is determined to close the borders and throw the key into the ocean. Some other minister is saying, well, Nigeria is reconsidering the situation with the borders. So that's from that person. But the question I wanted to ask you originally is about the pension funds that the state governors are saying they would like to borrow about 17 trillion from, starting with about 2 trillion, to fund infrastructure development. Now, the National Union of Pensioners is saying no, governors do not have any authority over pension funds in Nigeria. One NGO, SERAP, has already written the president to say, look, the president should use his good offices to prevent governors from accessing funds under the contributory pension scheme. These two questions, if you will help us
let me take the border issue.
Yes.
You see, in economics, we have what we call the Robinson Crusoe economy. The Robinson Crusoe economy is an hypothetical, and it's an economy that doesn't exist. The world economy thrives on investment flows, trade flows, and people movement. We are not in a lockdown situation. We have been told in the past that, because of border lockdown, there will be no Boko Haram. Because of border lockdown, there will be no narcotics. Because of border closure, there will be... But that's not true. We are in a trading world. We have signed the ECOWAS protocol. We have ratified the African Continental Free Trade Agreement. So from January 1, effectively, you are going to be having movement of goods. We are the beneficiaries because of our scale and because of our certain efficiencies. We are going to be able to benefit from an open regional integration and open borders. So I think that the borders will be open. A closed economy does not satisfy anybody. If that is the case, why don't you just close the airports and everything and let us thrive internally? Close the seaports, close the road, so that you can then grow. That model does not work, I think. So the old model of economic patriotism without talking about globalization and trade is not a practical model. Now, on the question of the pension fund, you see, pensions are people's savings. Pensions are invested in safe, normally in gilts, so that you can get when the time comes, the pensioner gets its returns. With all due respect to the Governors Forum, I think raiding the pension fund would be a very dangerous precedent. The state governments themselves, they took money in the bond market, 50 billion, 100 billion, 200 billion. I want you to go and audit and see what each of these state governments have done with the bonds. So if the money they borrowed from the financial markets have not been well and efficiently deployed, Where is the guarantee that the one that they're going to take from the pension, which is for the people's retirement, will be used seriously? And when the time comes for redemption and repayment, and the state government say they don't have the money, we are not going to use pension funds for security vote. We are not going to use pension funds for this. And that is not to say that the state government themselves are not, they're not some good ones or not. But so far, the records and the history shows that they have not been prudent, and that the acts of fiscal consolidation cannot be shining examples of fiscal efficiency and fiscal consolidation. Therefore, we shouldn't experiment with people's pension. It took a long time before we passed the Pension Act of 2004. It took a long time. The total funds in the pension pot is about 13 trillion or 14 trillion naira. Don't forget that because the pension guidelines were strictly adhered to, that was why during the margin calls and everything in 2008 and 2009, no pensioner lost his money. They got their money as and when due. So when the recession came and people were being laid off, you found that people could get their money. I think it's only prudent and efficient that the pension funds should be allowed to be deployed in the market. And from there, that same market, the state governments can raise money at market rates to carry out and execute projects which will have an internal rate of return which will more than cover the cost of the borrowing and to achieve good. In any case, state governments, if you are borrowing in what we call revenue anticipation bonds, so that when your revenue comes, you use that to retire it. If you are going to do that, go and get rated. If you are going to do that, go to the market. The pension funds can invest in the state bonds, but that way they would have gone through a very good process. But to allow the pension funds to be there and to be rated for whatever purposes will not be a useful deployment of resources in Nigeria.
Well, rated is really the only word. And now the link is obvious, but while we have you here, I'd like you to just touch on the issue of security and how that seemingly intractable war impacts the Nigerian economy. We've talked about diaspora remittances this morning, and the fact is that unfortunately, foreign investments do not even amount, they're completely dwarfed by diaspora remittances, which you have said is just somebody sending money to their loved ones. That is our inflow in this country as a result of the security situation. I'd like you to touch on that.
Well, you see, again, you talk about inflows and outflows. People want to, money is a store of value. If you look at total domestic account balances in this country, it comes to a significant amount. Why would anybody leave money in dollars when you had high interest rates in naira? It's because of the rate of inflation, because of the sovereign risks. And so if you allow for free flows of money, the Nigerians in diaspora are quite significant. We're talking about 23, at one point got to $26 billion. That in itself, the entire Nigerian stock market is about $20 billion. The Nigerian budget itself is about $30 to $31 billion. You can easily fund your budget, if you look at it in that context, with the size of the diaspora flows. But when the diaspora monies come in, it's converted into naira. It helps to stimulate consumption. Consumption leads to production, and production leads to growth. So it's a very simple formula. The countries like Philippines, like India and others have used diaspora flows as a catalyst to drive consumption, and you have that consumption-led strategy which leads to growth and creates employment. So, and you see, the GDP is the total value of goods and services produced in Nigeria. The GNP, which is the gross national product, is the value of what Nigerians earn here added to what Nigerians earn abroad. And that's a better measure of the wealth of a nation, because you deduct what foreigners earn here and take it out, and you add what Nigerians earn abroad and put it together with what Nigerians earn domestically. When you put that together, you get an income per capita which is higher than what you see. And when you add the informal economy, you find that the economy is probably more robust than is being projected or presented. But it has to be organized, it has to be measured, and it has to be led, and not by draconian measures, but by free market policies.
All right, I know you're pressed for time, but just quickly, this is a breaking story this morning on the front page of Business newspapers all over the country about government spending being more than private investment for the first time since 2010. Government revenue hasn't increased, but government spending being more than private investment. What's your take on that in about a minute as we wrap up?
No, but this was expected. What happened was that the government was getting their exchange rate at 320. The private sector were getting their exchange rate at 360. Now, the government the central bank is using 380 to actually monetize the dollars that came in. The government, because of the lockdown, the government workers were working from home, so overheads dropped. The government reduced subsidy, so government revenue. The truth is that government revenue has improved between March and now. The question I asked earlier: what is the government using this money to do? To complete the bridges, complete the roads, kick off the railway, and improve the quality of life of Nigerians in terms of healthcare, education, and transport and infrastructure. If you do this and do it consistently at a level that is impactful, this economy will take off. So it's a combination of government investment together with private sector investment. But private sector investment has to be more, and that is investment-led strategy that will take this economy into recovery in the year 2021.
Well, thank you very much, Mr. Bismarck Rewane, for joining us on the morning show today. Always a pleasure to have you join us with your brilliant insights.